Hi, this is Elizabeth Cross-Nicola, and I'm delighted to be filling in for John Seacrest, who is in Barcelona at this time, enjoying some sunshine as well as the opportunity to talk to some international investors there. So we're going to be recording the session tonight, and we will be hosting it on our YouTube channel. So for people who are unable to stay for the whole thing, or you want to share it with your friends, then just go to Seattle Angel Conference YouTube channel. I'll put the in the box as we go, in the chat box as we go along. So I'd first like to have people introduce themselves. Let me tell you, I'm a founder of a Downstream Therapeutics. It's a health med device combination startup. And we are in the early MVP stage as well. I've been involved with the APIS Health Angels program and very interested in fostering education for investors and startup founders. Thank you for joining us today. I think I've gone through everybody, and what I'm going to do is introduce to Minda. Now, Minda actually started as an investor with SAC, and I think, you'll have to tell me, was it 13?
I started with SAC 15.
15, and then was a fund manager, similar to the roles that a couple of people on here are playing. And then broadened out into First Row Partners and a few other investment initiatives that you have. Minda's an excellent speaker, and I know that you're going to really enjoy this opportunity to hear her talk about due diligence. And so I'll let Minda give the rest of her introduction, and thank you particularly for joining us tonight. We're really excited.
Absolutely. Thank you so much for having me, Elizabeth, and for having everyone introduce themselves. And I think, this is the exact audience I had in mind, which is a mix of founders and funders. The reason that I like bringing those two people together is that these are the two parties in due diligence. These are the two parties in fundraising. Anytime I'm talking about a topic, it really makes more sense to me to talk to angel investors and founders together, and VCs too, because I think that it's really nice to have everyone on the same page. And one of the things that Yoko and I, as part of First Row Partners, which is a small pre-seed fund based in the Northwest, we invest across North America. One of the things that we really advocate for and have really centered our programming around and outreach around is in reducing the power and information imbalance between founders and funders. And I think this is one of the places in due diligence where it really starts to show up. And so I think there's an opportunity to talk about not just sort of the details of what to do during due diligence, but the dynamics of due diligence. And so we'll get into a little bit of that. And so the idea for this talk is to really go from someone saying, yes, I'd like to invest because you had a great pitch deck, great conversations, you were able to answer their questions, and they said yes. But then there's this due diligence phase that comes before they actually sign and wire. And a lot can happen in that phase, and especially in an environment like we're in right now, where it was a very frothy, hot market, and then now things have changed. What you're seeing is that a lot of times during this due diligence phase, things are being renegotiated. Founders are finding that their investors that verbally committed, are dropping out, or, finding reasons to sort of, decline the investment. So I think that it really goes even more to show how much of a role a good founder can play in navigating this, because they're really the quarterback of this process, because they're the ones trying to close this deal. An angel or a VC, they make lots of deals. That they always have multiple things going on, and you want to be the one that gets across the finish line. And so we'll talk about what that success can look like. And a lot of this is sort of my point of view. I did, as I developed this, go out, and you'll see I have a couple of quotes embedded in here from other folks in the ecosystem to kind of express some of their points of view on some of these aspects. And so I hope you find that useful as well. And then I'm sure there's a lot of collective wisdom in this group, as there always is. So I look forward to doing some Q&A at the end. So the first thing I want to talk about is just sort of where I'm headed with this talk, so you can kind of see what I'm covering and know where your questions might be answered or where you might have some that you'd like to address with me toward the end. So I'll go over a little bit about what I think due diligence is and sort of where it fits in. Organizing documents, so that data room and how to manage that. Just in general, what to expect. How long does due diligence take? What kind of questions do they ask? What's important? How can things go wrong? How to diligence your prospective investors as a founder and why that's a really important thing to do. And often kind of people forget. They're just so excited somebody said yes to investing that they don't think about that they need to do due diligence on this person, group, or fund as well. Talk a little bit about how do you manage that deal momentum so that you don't lose the excitement of the yes before you get to the check. Communication about really negotiation and communication and sort of how that can be happening during due diligence and how to think about that. And a lot of times this also is where lawyers do or don't get more involved. So we'll talk a little bit about that. And then just, after you get that check, you have to be ready to onboard and build this relationship for the long term. So what things can you do there? And what might an investor do as well? And kind of how can you get that off to a really solid, good start? And then I'll leave you with some resources that I think have been helpful. And maybe you guys will even have some more to suggest. So just to kind of go over where I'm headed here with what due diligence is, it's really about, to me, I think of it as, let's eliminate surprises. We'll never, and especially what I'm talking about is the kind of due diligence on a pre-seed or seed stage company where you're talking to angels and early stage VCs. I'm specifically not talking about M&A due diligence because I think that is separate. So if you're looking for that, that's somebody else's talk someday. We'll talk a little bit about process and timeline, references, what to build for, what to have ready. What kind of different vehicles are you using to close this, and how to talk to your investor about what you're using as an investment vehicle? What's happening during due diligence? What's the investor doing on the other side, so that you can kind of think about how to feed their process as much as you think about your own. And then who do you need to have around you? And so we'll talk about the team that you need. Being able to have an attorney that is your advocate, if and when and you may need them. And also talking about how a peer founder with experience, just maybe 6 months to a year ahead of you, can also be extremely valuable. So that's just kind of a quick overview of where we're headed. So I think that Kate said it really nicely. Kate was a fund manager for SAC a few years ago, and she really sees it as this opportunity for really getting to know each other, right? There was sort of this opportunity for you to be persuasive and them to ask you questions, and everybody's getting excited, and then they say yes. Due diligence is about removing surprises. And hopefully you've tried to reveal a lot about your business, good and bad, throughout the course of the, getting to that commitment of the investment. But due diligence is really about setting yourself up for success and giving a lot of information as appropriate over to the investor so that they can commit and sign and feel like, it's not about eliminating risk, because your investment is a high risk investment. But it is about knowing how well your IP is secured. What are the customer contracts and how are they structured? Do you have employment agreements set up and, people secured in their work in an appropriate way? So some of those things that are important to have, that you don't want as surprises later. We'll talk a little bit about how to make sure that those are that you front load those things rather than hope they don't ask, because then you might get to the very end of the process and you say, oh, by the way, we have this cap table issue. That is the wrong time to be talking about that, because some things are fixable, but if you bring them up at the very end, you might really turn an investor off who feels like you should have very much brought that up sooner. And we'll wonder, what else haven't you brought up? And why is this coming up now? So front loading anything you think might be an investor hot button or surprise, and really getting to know them and having this be a good back and forth. So we'll hopefully come away with an understanding of what that looks like. But high integrity is, I think, probably the most important aspect of how you conduct yourself during this part, because you're building trust. And if you lose that by overstating your status with a customer, for example, or sort of misstating something about your numbers because you wanted them to look better, those things can really destroy the trust you're building with that investor and can often cause them to want to back out. So we want founders to be receptive, but they need to stand their ground. Founders need to be, high integrity and trust building. I also would say investors really should think about their conduct in this relationship as well, especially as in early stage, especially with first-time founders. The investor is really in sort of the power position here. And so you want to be aware of that. And in terms of conduct yourself in a way where you're not abusing that ability to take their time, to ask for a lot of information that you may or may not need, and to conduct yourself in a way where you are an investor that people want to have in their company. So it kind of, the very first thing we start with is after the yes, or very close to it, you're sharing a data room. And the data room is a collection of documents that you may organize in a Google Drive or on Dropbox, or, kind of next level up might be, some DocuSend type things, or AngelList stack, something that has sort of access controls. Or if you're in, healthcare biotech, you might go with something that is like a very clear auditable system of who has accessed what and when. And that would be something like the venue systems. And so there are sort of different levels of specificity for doing data rooms, from the general to the very specific that you might decide to use. But I think it's really important to get this ready, to know when to share it, what you might add to it during the process, and then how to kind of manage that. And so we'll talk a little bit about what that is. So using a file structure to make it easy to find things, and managing access and privilege is also really important, because you do want to maintain some control over your documents, but you don't want to create a lot of friction. I'm actually talking to a founder right now who I'd like to bring another investor in. And he said, yeah, I'll send you my data room. Great. He sent me a link to AngelList stack. So I go through and I put in my email and I get the access and I can see the files. Well, I shared it with the investor that he said I could share it with. And she said, I can't get in. And I'm like, oh, great. Oh, well, I needed to add her email. Well, I wish he had told me that. These friction points meant that instead of having a positive reaction to this founder, her first reaction was she hit a wall, and she made a whole bunch of assumptions based on my quick blurb about what it was. I had to sort of correct what her thinking was. And she said, oh yeah, no, I do want to see the deck. Okay, now I have to go back to the founder, ask him to add her specifically by email. It would have been a lot easier if he'd been willing to just send me a PDF, because, that check could be $1 million check. And so there are trade-offs you make with how you operate in terms of how much friction you create, how much security you maintain. And I think that it is easy to think that ideas can be stolen, and they can. Rarely will anyone be able to execute based on seeing something that is proprietary to you. So think a lot about how much privacy you really need, especially at this stage of your company. I would say that if you're in biotech and you do have some proprietary things, then yes, you may want to go with a more involved system. But in general, I would say that keeping friction low is very important. Not necessarily all the controls and access and thinking that you're sort of masterminding access, because frankly, just assume everybody is going to see your deck. Now, if you're putting sensitive information out there, one way to do this, and I had a Techstars company I was mentoring say, well, when Jonah's asking me for a data room and they said I can't have a partner meeting until I have a data room shared with them, and I'm not ready to share my data room with them if they haven't even made a commitment. I said, great, perfect. Give them a data room. It doesn't have to have everything in it that you consider a data room. Make it a data room you're ready to share. Have the deck in there, have a couple of articles in there, maybe have a couple of bios of your team. You can make a data room anything you want it to be, and you can always add to it and then let the investor know, I added a folder with all of our customer contracts. So you can really dial up, and usually not back, but dial up what you offer and provide. But if someone says they have to have this for a partner meeting, well, you can usually make that happen. Just understand that sometimes you can decide what you want to withhold. So let's talk a little bit about Alan's perspective on some of this. Because you can spend a lot of time in due diligence, and this is why you want to keep that data room always up to date, because these things can get really involved, and it's nice to just always have the data room ready to go when someone says, I'd like to invest in your company. It's a cost, but you have to keep running your business, organizing it, make it low effort. Think about how you want to do it. How do you want to do a Google Drive and give people individual access? Do you want to make it, how hard do you want to make it to access? Where are you going to put these files? How are you going to structure it? And then keeping it up to date is really important. I think that when you do this, you're able to really capitalize quickly on people's interest, and be able to provide the information you're ready to provide to support the process. So here are some of the documents to organize, because I think this is sort of one of the key pieces of interest. One is on the left-hand side, I have sort of like what I think are the expectations I would have. A financial model and unit economics. And I think that this is really great because it shows me your thinking. As an investor, it doesn't necessarily mean that I want to hold you to those numbers as if it's some sort of forecast, but I do want to see what you think the variables are and what you think the baseline may be. And that's going to help me see things. It's also going to help me see your hiring plan, hopefully, and how much you're expecting to burn versus bring in revenue. And, how is that ratio sitting with me compared to other companies that I'm invested in? Formation documents are very important. And this is something where you can put those in there. That's just a nice sort of easy first check mark to give people. And your cap table and your vesting schedules. Now, there's varying levels of information you may want to provide about your cap table to prospective investors. I think the main thing that I'm looking for as an investor is to see on the founding team who owns what, how have they divided equity, and is it commensurate with the kinds of contributions that are being made? Is there somebody who has equity who's not contributing to the company, maybe a former co-founder? Now I'm seeing potential issues and red flags potentially, or I want to see how much has been set aside for the employee option pool. If it hasn't been set up before I invest, it means that it will have to be set up later, and I will be diluted by that. I'd love to see it set up in advance, so I'm looking for things like that. I'm also looking for the vesting schedule to see that it follows the norms of that sort of 1 year cliff for 25%, and then the rest over another 3 years on a monthly basis. I want to know where everybody is in their vesting cycle. And some investors, especially venture capitalists, usually not angels having, a little less leverage there, will, even into the seed round or beyond, ask you to reset your vesting schedule. So understand that that may be something that comes up as well when you share that kind of information. Your board meeting minutes, they want to know that your governance is buttoned up. They're really, that becomes more and more important as your company grows, but you need to have a strong foundation that your formation documents are in order, your board meeting minutes are being captured, you're doing things right. You're not creating a risk situation that is going to affect the investor. Financial reports, if you have them, it shows me that you're using a financial system. And so you're going to be a good steward of my capital if you know where your money is going. If I'm getting bank statements instead of a P&L, I'm very concerned. I don't know if you're going to be able to make good use of my money. And making good use of my money means knowing who you can hire and when, how much you can afford to pay people, and what you can buy and what you can't yet. Because the main thing is once I put my money in, I need to make sure, as your investor, I'm looking to see that you don't run out of money before you become successful. And if you can't be sure where that money is and going, and if you can't forecast your cash position, then my money becomes much more at risk. So these are the kinds of communications you're making by what kind of quality of financial information you put forward. You're telling me a lot about how you're prepared to run this as a business, and to understand sort of the management of capital and cash that you have to be able to do. Contracts, agreements, and terminations, especially if you've had to let people go. This is really important because it's, again, something that can surface later and be a real problem for the investor. If you've had a co-founder leave, if you've had to fire someone, if you've had to go through any sort of HR thing, you're really going to want to have that buttoned up and documented and put that forward early, so that the investor is finding out about this as early as possible, so that they don't feel surprised later. That's one of those trust building things. If something hasn't worked out with someone, you really want to put that forward pretty early on. When you have patents and IP and things like that, you're really going to want to provide top level information. You don't need to put proprietary, secret kind of sauce stuff here. What they need to know is that you have IP and you have it appropriately captured in your company. That's really the due diligence part of this. They may want to know some of the things about what the impact is of that IP on your company, but really what they're trying to figure out is, okay, they started this company while they were doing their PhD at a university. Do they have all the right licensing agreements in place? Or if they have the really exciting algorithm of some sort, what kind of patent do they have? Where does it stand? How are they protecting what they think is an important defense of the value of their company? Because if I'm going to invest, I want to make sure that that value is maintained as an asset. So how well have you captured that asset and maintained it in this entity? And then technical specs and architecture, especially if you have more technical investors, they may like to see schematics and diagrams and things like that, which might be helpful. Over on the right-hand side is the extra credit. And this is where I think a lot of founders can do more better. Because I think this is your opportunity for an excited investor who wants to share it with their colleagues to include things that help them talk about your deal, because it's always hard. If I have to write your blurb and describe it to people and tell people what a great presenter you are, there's so much you can do by just having a Loom video in there that I can share, or a product demo, or, someone that I was working with actually created a list of industry articles that were really good, credible sources that talked about the, technical aspect of what he's building and what the market opportunity is. And so it's really nice to see it referenced from a third-party point of view, and it kind of kickstarts my due diligence, but it's nice for someone to put that forward to kind of give some credibility to what they're saying in their deck. You always want to have the most current version of your deck available. Team bios and references are really nice. Now, there are two kinds of references I look at. One is a customer reference type, and the other is a professional reference, and I do both. For professional references, I'm going to want to, and references, as much as I would like to front load them, I try to wait till the end when I'm pretty sure we're going to invest, because I don't want to overuse those references that the founder has given, because I know other people will be looking at them too. So with professional references, I'm always going to want to contact that person by phone or email and ask them questions. And so you should have those people teed up and ready, and not be trying to scramble to pull those folks together. Once you have an investor, you should have that ready, their email, their phone number, and make sure that that person knows that someone's going to be reaching out to them so that they're responsive. On the customer reference side, those are some of the most helpful things to me to understand that what you are saying is happening with customers, whether it's what they're using, how they're using it, what they're paying, matches up. And in SAC, sometimes we actually, back before COVID, would go on site visits and actually, tour factories to see things in action. And that was super fun, really, really helpful. Not always possible anymore, but customer references, I think, are pretty important. I also know that you don't want to overuse them as a founder, so I try to limit that. And sometimes I will talk to, I'll tell the founder, hey, I want to do customer reference checks, but I'm happy if another investor has done them to talk to that investor and leverage their notes. And I think that that is often, possible based on different things. A lot of how deep I dig and how quickly and how much information I request. I try to request things that exist. I try to be very sensitive about requesting things be added to the document list that they have to then create for me. And I have to understand that my check size in relation to their round size is a lot about what I, as an investor, need to be cognizant of to be a good steward of their time. In other words, don't act like you're writing a $3 million check when you're writing a $25,000 check. I know that if you're an angel, that is a lot of money. I get it. But it also, you need to think of it in the context of this. And also that even with all these documents, you'll truly never have enough to know everything for sure. So having your own process, your own methodology for DD, and being good at getting efficient at that is really important, and especially with the founder's time. So that's a little bit about documents to organize. We'll go back to that if you guys have specific questions. Laura Malcolm's a founder here locally. I think she's awesome. She's done some really great things with her business, Giving Kind. And this comes to some of the questions about maybe technology or numbers, where you may or may not, as the CEO, have all the answers. And what Laura really impressed me with when I talked to her during her due diligence phase was that she could run us through her model in all manner of ways. She didn't say, oh, you should talk to my consultant who built my model, or our CTO can tell you that. Think about who in the organization you're tapping to be the expert, knowing that the CEO should be able to answer at least a couple levels down. And it's great then when they hand it off and trust one of their other founders enough to be in that conversation. So that can be good, but it can be bad if they say, well, I know what our revenue forecast is, but I don't really know all the variables. Now that's going to raise red flags. So a lot of times it is good to kind of, as an investor, I learn how much the CEO is really where their strengths are and how deep they go. And I'm always impressed when someone has taken the extra time to deeply understand the aspects of their business in an area that isn't their domain expertise. Like, I know that they've really worked to develop a lot of understanding so that they can be the CEO of that company, and that is something that someone else is likely really in charge of. So really thinking about how you present numbers and talk about details is important. And so on the flip side, so that's from the founder side, on the investor side, this is an area where you can get some good signals about how the team divides responsibility, how they share information, and how much they are really working together versus very separately, where they may not know enough about what each other is doing and some of the details. So there are some opportunities in there for both sides. So there are a couple of different types of investors, and they all have different ways of sort of thinking about things. For a lead investor that's a VC, a follow-on investor, VC, angels and angel groups. So a lead investor typically comes in, writes the largest check of the round, galvanizes other investors, and maybe the first check in the round, and will also be the one that others may ask due diligence information for. So the lead investor should have always done the most due diligence on, your customer reference checks, on all these other things. And so if I'm a follow-on investor in this round, I may want to talk to the lead VC and say, so are you taking a board seat? Which is common for lead investors. I may want to know, have you talked to their, have you talked to that incoming CTO? Have you talked to that customer that they talk so much about? So I'm going to potentially, as a follow-on investor, sort of lean on the due diligence that a lead investor does. Like I said, lead investors may also take board seats, have more information rights, are likely, potentially, traditionally, the ones to kind of, if there's a bridge round needed, be able to galvanize that. And when there's a next round, be able to kind of open doors for those next level of investors. And so I want to know, as a follow-on VC, that there's a really strong lead, because when things don't go well, I know that they're the ones, hopefully, getting involved to try and fix things. If we need to go get it, if we need to replace the co-founder, if a big, customer leaves, if revenue dips, if all of a sudden things are going so well that they need to hire really quickly, can they help, screen people? What are they doing actively to make sure that this company gets to the next level? Angels and angel groups, I think, there's a lot of challenges for individual angels because you're usually one of the very smallest checks. And so it's great if you can leverage what other investors have done and use everyone else's time well as an investor will help you get the most out of it. So being organized about what you want up front is really helpful. But you probably will not get the opportunity to set the terms. You are unlikely to get a board seat unless you have some prior connection to the founder or writing, a different kind of, special kind of check or something. They're just, it's a little bit more rare. Angel groups often do due diligence in groups, and Seattle Angel Conference is a great example of this. What I will say is that angel groups, it can kind of get a little squirrely and out of hand from a founder's point of view. And so as a member of an angel group doing a group due diligence, I think it's really important to know this. And when I was a SAC fund manager, I tried to really help manage this. I told every single one of the 6 finalists that if at any time they were getting asked for too much information or too much time was being taken from them, that they could always come to me and that I would separately, without throwing them under the bus, help rein that in. So Seattle Angel Conference is really what I think of as an angel accelerator, where we ask the teams of due diligence folks to do above and beyond levels of due diligence in a somewhat inefficient way so that they learn. And I think it's a fantastic process. I think you do a lot more due diligence in SAC over a longer period of time than you'll ever get to do again, unless you're a VC with a lot more, check writing and you're doing a lead role. I think it's important to understand that that is a little bit of an unusual situation. And in fact, we tell the founders that go through, hey, this is a unique due diligence experience. It shouldn't always be like this, but at the end, you should be prepared to go through anybody's due diligence because of the extra intensity behind those. As you move into other groups, it should be more efficient, less time consuming on everyone's side, and everyone should be a little bit better at it as they go. And I think it's really important not to try and think of SAC as being the norm that you're trying to replicate in terms of the amount of time and intensity on due diligence, especially for the check size that angel groups are usually writing. But just really being aware, as a VC, I now hear quite a bit about angel groups and the overstepping. And I know it's really exciting to do due diligence. You have a lot of questions. I think it's really important to focus on not a checklist, but to ask yourself the question, is what I'm asking for going to inform my investment decision? Or is it just because I really want to know it? I'm so excited. And so separating your curiosity from your investment decision criteria and what you need to do that is really important. And so some thoughtful preparation in your as each deal is different, they're all different shapes and sizes with different kinds of risks and opportunities. You want to really sit down at the beginning and say, what do I really need to be sure of? What are my kind of like non-negotiable checklist kind of things? Like they have to be a C Corp, all these kinds of things. There's some like basics, right? So what are my basics that I know I need to check off? What are my mid-level things? And what are the things that, where can I surface things that might be real problems? Like to me, cap table is one of them. I really want to understand their cap table to know if there are any issues. I want to know for sure that any money that's been put in by the founders is captured as an equity position, not as debt. Because if I invest my money, and if I invest $50,000 and they've loaned the company $50,000 as debt, they shouldn't, but they could just repay themselves with it. It would be totally legit on the books. But that's not what I want my investment dollars to do. I want my investment dollars to be about the go forward position of this company, not repayment of expenses and founder contribution to the capitalization of the company. So that's another sort of thing that I'm really careful about looking for. So know what your kind of caution points might be that you need to check. And then what are your sort of just business risk questions that you want to explore, and how much of that can you do on your own? And then be really good at preparing for your founders what you want to know, because you'll set yourself up for a good relationship on the other side of the check if you've done a good job during due diligence. On the founder side, be consistent and understand multi-party communication. If you're talking to me as one investor, and you're talking to my friend Alex in New York, and you're talking to C Change here in Seattle, just know that we're all talking. And that if you're saying, oh, our valuation cap is 9 million, and Alex is hearing it's 12, and C Change is hearing that it's 5, we're all really wondering what the truth is and why we're all getting different information. So just understand how much investors talk, whether that's angels or VCs. Like, it's not that big of a community. And so just be super consistent, be really high integrity. Don't try and stretch any truth, because it will not help you. It only hurts you. And be consistent about your information sharing and how you're doing it. So stay organized, be consistent with the numbers you put out, with the information you share. You can share different levels of access of information, but always be sharing things really consistently. And if you do change something, if you say, maybe you resolve something on your cap table, then let folks know that you've resolved this on your cap table, and let them all know that. So just really think about the fact that everyone should be getting consistent information. You're going to look like a capable CEO. They're going to feel like they can trust you and not have to dig further and take more of your time to kind of check and verify that you are, in fact, worthy of their capital. So just a thought about how communication quality can really matter. Doing due diligence on your investors. I think this is so great. I love it when founders want to talk to my founders, and they tell me things like, oh, I talked to one of your founders and they said da, 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 and they're really happy they have you on their, and I'm like, I love that they did that. Like, and I should expect it. Just like I expect to do professional reference checks on them, they should do it on my firm. Kinds of questions you can ask, whether you find someone on LinkedIn that has them as an investor, you can usually figure that out through PitchBook or asking around, directly ask the investor, can I talk to 2 founders that you invested in the last year, or that you invested in 3 years ago? Or can I talk to a founder where their business, didn't thrive? Or can I talk to someone who had huge success? Whatever criteria you have, ask them for it up front. That's fine to ask. But these are the kinds of questions that I think are really useful to ask of the founders that you do communicate with. And you can put this in email and just say, I always give people the out of a phone call if they don't want to put something in email, and just say like, hey, feel free to write me back via email with some answers to these questions, or drop me a voicemail here. And that kind of, if they say, oh, I'd like to drop you a voicemail, then you know that they might have something that's not so positive to say. So find ways to surface this information that is a little bit sensitive. Deal momentum. I don't know how many of you have ever been in enterprise sales, but it will not surprise you that as the founder, you're really trying to keep deal momentum going. As the investor, you should expect that the founder is trying to keep the deal going. And so, you know, I do occasionally get nudges from founders when I'm in due diligence with them and they do such a nice job when they say, hey, Minda, thanks for sending over that Q&A doc. We responded to it. We'd love to set up that next meeting you talked about. Oh, and by the way, we did close that customer you talked about, and here's an industry article that I thought might help you with your investment memo. I'm like, yes, I will respond to that email and get on the ball for that. So don't be afraid to reach back out to investors, and investors expect it. I always feel bad when founders have to nudge me. That's just not it's not on brand for me. So when that happens, I know that maybe I've taken on a little too much. I try and have very few deals that I'm in diligence with in parallel. That's because I do like to dive pretty deep. And so I need to have a lot of focus as I do outreach to my network, industry research, gathering information, starting to pull things together for an investment memo. That's actually a big part of my job, is doing that part really well, because the quality of my decision is super important. You know, the things you should be doing as a founder are really to, in a friendly way, keep those nudges going. And a great way to understand how to do that is up front with each investor, ask them what their process is. Say, you know, do you have a partner meeting? When does that partner meeting take place? Is it always on Mondays? So you kind of know when you're going to get answers back, right? Ask them what they like to know during due diligence, so that you can, if there are any surprises there, you can kind of know. So ask those things up front and then hold them to that to some degree. But that's your opportunity to nudge them, is by telling, you know, them telling you what their process is, and then you can feed into that and close your deal. So you just don't want diligence to go on too long. I had a founder that just didn't understand this part of closing the deal, and it made me really concerned that if they were trying to sell to enterprise, that this was not a good signal. And so, you know, it raised a red flag for me that, like, they couldn't keep up with my pretty limited information request. I was like, am I asking too much? Am I expecting this to go? Why is this, you know? So you raise concerns when it goes slowly. You want to be on it. I like it when founders say what their timelines are. So if you know your round is about to close, let investors know, hey, I expect us to close within the next 2 weeks. So is your process going to allow you to get to a verbal commitment by X date? Talk about that up front. But, you know, so timelines, process, and expectations, you as the founder can really front load that. If the founder doesn't, an investor should step in and describe their process. So if they are not doing that, then help them out and explain yours and make sure that those two match up. Alex is a general partner in New York. He invests exclusively in pre-seed deals. He has a $68 million fund. He used to run Techstars New York. I just really have found him to be a great mentor for me, and I'm a venture partner for his firm. So I work with him and his team a lot on deals. And I think this is fantastic advice, because he's always about what matters and what doesn't, and what you should just sort of not spend a lot of time on, and also how much a experienced, trusted investor or CEO can help. So there have been some deals that I've said that we won't invest in as a fund because they don't fit our theme. But I feel like I've built some really nice rapport with the founder, and I'd like to help them. And maybe I've mentored them in Techstars or something like that. So I'll say, you know, feel free to use me as a sounding board as you're going through and getting investment. So that's where I get the call of, Madrona needs a deal room before they can do a partner meeting. And I'm like, we'll give them a deal room then, you know? And they were like, oh, yes, of course. So, those are the kinds of things that you can help unlock for other people. And I fully expect that anyone who's been through due diligence then thinks about serving this role for another founder in their network. So here's what Alex is thinking about when he's thinking about, and I think in his blog, startuphacks.vc, you'll see a blog post on this, which is that there are really two parts to understanding what the investment is. There are the economic terms and there are the control terms. And I think that early stage founders at the beginning, the company is still founder controlled. You don't really have a lot of big board decisions. The strategic plan is pretty, we're just trying to figure things out. There's a lot less going on the control side of this company at this point. It only increases in importance in time. So it's really important that you do understand the attributes of this side of investment, but you're going to focus a lot on the economic terms. But you really need to understand that from a venture capitalist perspective, especially since they're doing this professionally with a fiduciary of an LP, that they have an investor, right? So their bosses are the ones who give them the money to put it in that fund, that they need to really do this in a way that is beneficial to their fund. So they tend to really, I think a little bit more about this and have non-negotiables. I think that economic terms are really important. For example, post-money valuations for professional investors, let them know the ownership percentage that they have. And this may be very important to a fund, less so because, when you're an angel, it's just your money and you deciding if you're going to take that vacation to Europe, buy a second home, or invest in this startup, and you have more flexibility and less accountability to other people professionally in your investing. But in my role as a fund manager, I need to be able to know the percentage ownership and predict and forecast my dilution, because I'm trying to understand in a portfolio how well this is going to return my fund to my investors. And so post money is a high preference for investors because they have more certainty and they know a lot more about what they own. The option pool, as I talked about previously on that cap table, that tells me whether I'm an angel or a VC, that tells me whose pocket is the option pool for employees going to come out of, and is it properly sized as of my money going in. So I also want to know that option pool has been created prior to my money coming in. Again, it helps me know how much exactly that I own of the company. And it helps me know that dilution has been taken by the founding team or prior investors, not by me right after I've invested. All of a sudden, I lose a little piece of my ownership because you've set up the option pool after my money came in. So that's a question and a negotiation point often on the economic side. Founder vesting, as I talked about, wanting to make sure you follow norms and potentially wanting you to reset. If you're 3 years into your vesting, by the time I come along and I'm writing the first, we're doing the first round and it's still a pretty early stage company, but you've just been working at it for a while, I might want you to reset, because I want to make sure that equity is going to someone who is actively working on the company and is going to stick around. And that is a huge part of the motivation and compensation for a founder, is the upside of that equity. So I want to make sure that they're still really in that stage of earning it through working on the company, because there's not a lot of cash compensation. I don't want them to just walk away and go get a great job somewhere. As much as that may happen, I don't want there to be a disadvantage to me as the investor in that regard. Liquidation preferences, I'm just going to put a little asterisk by this because there's a lot of questions you may have. There's a book called Venture Deals by Brad Feld that explains it beautifully on page, I think, 33 or so. But it is really important to understand. And when investors ask you for this, you should understand what you are negotiating and what the impacts are for you, your prior investors, your future investors, and for you as a founder typically holding common stock, while they will be holding preferred stock. Liquidation preferences can dramatically change the outcomes for founders and other investors. So really understanding that. Pro rata, it's like, can they keep their ownership percentage in the next round and get the opportunity to invest more? Some people may want that documented in a side letter. Other people may not. It's really sort of you pre-selling your next round. And it's not a commitment for them to do the pro rata, but they want that opportunity available to them. And I've done a couple of pro rata investments where I followed on my investments, and it's been really exciting to get to invest again at the next level. But there are also a lot of pressures for the investors who have that pro rata, even in writing, and then you get to Series A and the new money in says, oh, by the way, no, we don't have room in the round for those folks. I know you promised them pro rata. So the founder then has to go back to their early investors that committed so early and say, I can't get you in this round, or I can't get you in for all of your pro rata. Now, if you have it in writing, you can stand your ground, and they're like, I can't get the round closed unless you sign off on not taking all of your pro rata. So will you? So that can happen. This is also where good and bad investors and founders can really find a flashpoint. So as the investor, if you're an angel, if you're an early stage investor, sometimes you just have to let these things go because you have to let that next round come together. You cannot stand in the way. You don't want to be that person that does that. So earn your pro rata if you really want it by being a great contributor, a great investor, and make it so that they want you at that next level and will advocate for you when the larger VC comes in and says, well, we need to get 10% of this company, and I don't want to dilute you, dear founder. And so we need to make sure that these other folks that are angels and small VCs don't take too much of the round. And I know you promised it to them, but here we are now. So this is very realistic. It happens every day, all the time. And I think everyone should just be aware of it. But this is where I think as an investor, you can really earn your pro rata and earn the opportunity to keep investing. But negotiating it up front is great. It's part of what you can ask for. It's, often easy to get, hard to keep. If the company gets really hot, it's hard to keep. But if you do a good job as an investor, it won't be a problem, usually. Control terms. Do they want a board seat? Do they want a voting board seat? That's a really big deal. You're going to then have to cover them for directors and officers insurance. So there's a cost to that. You're going to have to pay for the time that they, like some board members will, make you pay to fly them in. So like really understand what kind of costs you're going to incur for having a board member. Understand if they're asking for information rights, but not a board seat. If they ask for a board observer seat, it means they have no vote, they have no fiduciary responsibility, and it's a lot lighter weight, but it can be really nice and helpful. They may or may not want that. They may or may not want a board seat, but they may feel like they need to have it. And the reason that they have it is so that they can really make sure their investment is being protected. So do they need to fire the CEO? Do they need to, so that's what control becomes about, is the board hires and fires the CEO and approves the strategic plan. And, really understanding what it means to bring on a board member, super important. And especially as you get toward investor control, usually like Series A, Series B versus founder control. This, again, like I said, rises in importance, but important to understand at the beginning. Let's see. So onboarding and ongoing success, I always like to think ahead, right? So acknowledging what you're trying to do, how they can help you, how often you'll be giving them updates, how often are you going to get updates? Like just have those conversations up front. Using their networks to fill in the round. Like once they invest, then they're a great reference point for other investors. Keep your data room updated. Write a blog, for their website, for LinkedIn, with the pictures and the, thank everybody. People sometimes really get excited by seeing their fund's name listed as one of the funds that invested. Think about all those things as you kind of close the deal and prepare for a great relationship. And then your job is then help the next one. I'll end with some resources before we go to questions. Venture Deals. It is a great book. It is an audio book. It's on Kindle. It has a free course offered by the Kauffman Foundation, which is like videos with Brad and Jason, the authors, and then homework assignments, and you can do it in groups. And I mean, VCs do it, angels do it, founders do it, tons of people worldwide do it. And it is just a great way to really learn the intricacies of term sheets and liquidation preferences and all these like insider things about how the business of investing works. And I just think that it's so great for everyone to be to know way more than they're using in their current capacity. Alex has a great blog at startuphacks.vc. I always like to say Seattle Angel Conference, great place to learn. And Yoko and I do Deals and Drinks once a month, where we talk about investing, talk about how we think about it, get founders and funders together. And you can either email me, or on our website, you'll find information about that and how to get on our email list. So I don't know. I didn't even know. I didn't even look at what time it was. I hope I didn't blow way over. So I will turn it back over to see sort of either what's in the chat or folks that, have any questions they want to just sort of raise their hand and ask.
Well, let's let you take a deep breath and maybe a glass of water. You've been amazing. I can't believe that's sort of like 45, 50 minutes of just going through some totally terrific content. Right, Nick? It was pretty amazing.
Okay.
So I'm going to ask people if they could start to think your questions. We're a small enough group that if you want to take yourself off mute and off camera and just ask it directly, you could do that. If you prefer, you can put it in the chat, and we'll pull them up as we need to go in case you're cooking dinner or driving or something like that. You highlighted on such very many things that I would love to pick up on. I'm going to ask one question while everybody's thinking, and then let people take it on from there. So at one point you said, and I totally believe, about if you have fixed things and you need to go back, you're a founder and you sent out your deal room stuff to other people and you find there's an error or you've got further along, how far back do you go on the investors who have expressed interest? Are you going back a month to refresh the information with them? Do you go back a little bit further to anybody who you think was really serious? Just curious as to.
Well, it depends on how significant the information change is. And is it an opportunity to nudge an investor that kind of fell off the radar and kind of say, hey, just wanted you to know I updated that financial model because now it really includes hiring that third engineer. And I wanted you to be able to see how that played out, whatever. Or you can say, we went through and got the employment agreement in place for this person, or that, we got them to sign off on the IP that they created, and now that's secured within the company, right? So whatever it is, you can share it as an opportunity to re-engage with someone. Hopefully you've kind of let people, you haven't let anyone linger too long in the indecision stage, because you kind of want to keep access pretty tight. And you kind of want to know who's moving through. And if they've fallen off, you're getting, it's like enterprise sales. You kind of want to put people on like a bit of a drip system. And then, but you may only let them have access to the data room for, like someone told me today, like, great, your access is all set up until August 12th. And I was like, okay, I guess I have to ask again after August 12th. I mean, but, founders will do that, put a little time pressure on it.
Well, that's better than saying we need a decision in 48 hours, which was the text that I got.
Yeah, and what I say to those is, what? I'm so excited that you have so much interest. It's just not going to fit our time frame for the due diligence we do. And I've had to miss deals, and that's okay.
Well, the due diligence is such an important component. And I agree with you earlier when you said it's really the investor and the founder who establish a relationship here for a level of trust that makes such a big difference. Now, one of the things that I wanted to ask you about is a little bit, I'd like to put a plug in for your deals and drinks, and Tessie did as well, because that is such an interesting opportunity for hear everybody's perspective. Maybe you would just like to give a little comment on how you get people thinking in a different way. I mean, you're driving a mindset of thinking that's a little bit different than others do when they talk about due diligence. Would you mind?
The main thing is that we try and help people really suspend their judgment on the company while they're listening and really formulating their point of view, and that we try and make that a really deliberate and individual process. Because in early stage investing, we may have all the same information and heard all the same things and come away with two entirely different points of view on whether or not we want to invest. And it's fine, but that's how it should be. I don't like to outsource my thinking to someone else. And I think that it's really what we try and do in Deals and Drinks is make it fun to develop your own sense of how you develop a point of view. So we're practicing good, hopefully great listening skills more than anything by listening to a founder pitch, listening to the Q&A, and then we use a framework to kind of help people drive through the kinds of considerations and questions that they might, that we think they ought to be thinking through as they decide if they want to take the next step. So we try to, it's called Deals and Drinks because we try and make it fun, and I think we do. So that's why people keep coming back.
You totally do. And it's, so there's two things I think of. One is your investment thesis that says, I'm kind of interested in these kind of companies, and therefore I have a bit of a point of view there. But the other is a point of view that when I'm listening to this data, it might tell me one thing. If my frame of reference of understanding is so much broader, like I've seen 10 other companies, and I know that when they tell me that we're going to get to market in 6 months, and I say, oh, perhaps that would be great and optimistic, but you'd have to show me that you've got these things in order. So it's the understanding frame of reference.
So it's like what we try and do is we separate facts, which is like today's Tuesday, or today's Wednesday. That's a fact. From risks, which is you have a long sales cycle already, and I don't know if you're going to be able to get it down. Maybe there's a risk in that. And then there is an open question. And I think it's really important to frame what you think are assumptions and you think are truths. Make sure that if you can frame it as an open question, I think you do yourself and the founder a service. And so we try and separate those things out. I think that's part of what I really, as I try and explain this to other people and keep sharpening myself on it. That's what I try and do.
Okay, so who else would like to ask a question here?
I'm not going to ask a question, but I want to thank Minda. Minda, I think, man, this is a great dump of so many things. But one of the things I want to call out, and that I'm going to ask you about in August, if you're on the Ask the Angels greater team, is the extra credit. I think that was great, and kind of trying to crystallize that for the founders who want to go above and beyond, and how they can show that effort, and offering that, I think, is wonderful. So thank you.
Yeah. I think understanding that, on the investor side, I want to share this with other people, either to get their opinion because they're an expert, or because I think they might be interested as an investment. So make it easy for me to tell them what you do and to showcase who you are and make you look great. And then the other thing is, that you're showing me that you're kind of understanding that I need to write an investment memo. No, not all angels do this, but all VCs, well, no, maybe not all, but most do, write an investment memo to say, at the time of investment, this is the market opportunity, this is the team, this is the product, this is the plan, this is why I invested, here are the risks that I see, because it's a great document to go back and look at later, or, in our case, we share with our investors. So if they understand that I'm doing an investment memo and they're putting things in their data room that help me, they're making my job easier. And yeah, I'm going to go out and I'm going to find things and verify them. But if you show me the industry association that you're using for a lot of the basis of your market opportunity, then that's going to just point me down a great path. So you're helping me, but you're also guiding me by telling me where you want me to look. So
yeah, because I think one of those things that we've learned is if the founders can kind of think more about what the investor needs and understand that, like from the pitch level and this extra credit, it allows you to then kind of sing their praises easier, even if you're moving forward and can kind of share that information elsewhere. So I just thought that that was a really great set of tips.
cool. Great. Thanks.
Ken.
Yes. Thank you so much for everything you've shared this evening. As I mentioned earlier, we're going down this path. This has been incredibly helpful. One of the things that you had alluded to, I think, kind of as a thread throughout, is there is an expectation of a give and take throughout this due diligence process. Being able to actually highlight, as you just itemized, the areas that you should go look at. Specifically in health tech, there are specific areas, because to your point, there's a long lead time. It's 18 to 24 months in any sort of enterprise sale in health tech. So keeping that in mind, is it, because in health, a lot of people don't understand that. They don't really get that. They don't grok that. So is providing really kind of focusing on, this is what it takes to build that market. This is, obviously where we are right now. We're profitable, but we want to grow beyond this. Is that really kind of the focus of the story from a due diligence perspective, providing all that support material that really kind of reinforces that? Or, is the focus on educating?
I think you've gotten the buy off on your go-to-market strategy before you get to the yes. What might come up in due diligence is your cash forecasting and your model of, okay, we have, how many people do you have doing sales? What is the cash on cash return for that enterprise sales cycle? Do you have enough funding to go through, right? So the details of how you're managing cash to implement that go-to-market strategy, I want to make, that might be where I'm doing my verification of some of that and may have questions. So that's kind of how I would think about that.
Okay, thank you. Appreciate it.
But you should be doing all the educating, I think, before you get to the yes. If you're finding you're still educating in due diligence and they still have doubts, then they haven't really committed yet. They're just really interested. So then I think if you're getting someone who says, oh, I want to invest, and then they're still asking those kinds of questions during what they call due diligence, maybe what you can do is turn it back to them and say, tell me about your decision-making process. And what are the key open questions you have so I can kind of give you the right information so you can make a decision.
Okay.
Like
and that's that give and take I was kind of referring to. So being able to really format the information that we're providing for the receiver, obviously it helps know what they're looking for. So thank you very much.
Sure.
Excellent.
Hi, Minda. This has been really wonderful. Quick question. You mentioned one of your founders that you're advising was feeling nervous about sharing a data room, and your suggestion was to share a limited data room. And I'm curious, would that, in a sense, be a red flag for you as a potential investor to see, to have a founder share like a very limited data room?
Because then I just know that there's more I'm going to have to ask them for. So it's a little bit of a hedge on their part to, if you're talking to an associate and they haven't yet gone to the partner meeting, you're not really in due diligence. You're still you're not even to the yes yet. But if they're asking for a data room and you're not in due diligence, I think you have a lot more leeway to be able to say, here's my data room, and you can, build it the way you want it. And then if you go into due diligence, then you're saying, oh, great, now that you're committed and we're in due diligence, I've added the following folders.
Okay.
Now you have our, this, that, and the other.
Progressive
Like during the
disclosure.
first, when I'm making a decision, I want to know how the founding team has divided equity, but I'm not asking for a cap table. But in due diligence, I want to see a pretty, maybe not the entire thing, but like a pretty decent summary so I can see more detail, right? So
Okay, that helps a lot. Thank you.
I see there's been an exchange of LinkedIn requests and things, so people are connecting with those. Those are good. Minda, I took the liberty while you were talking of putting in 2 or 3 different things. One was your LinkedIn profile, your first row, and also something else. Oh, your yeah, I had to paste that one in twice. A couple of the books that you'd suggested.
oh, good, yes.
If there, maybe at the end of this, if you have a chance to send me your deck, if somebody had a specific question, I think
Yeah,
really
and-
the videotape will be available for people.
Yeah, and so the other thing I would say is Yoko and I both have mentoring calendars that slots on Friday afternoons for people who are not yet fundraising or who have questions or think, basically it's like, I'm not talking to you about your company to invest, but you have questions. And that's what that mentoring calendar is for. So if you connect with me on LinkedIn, let me know, hey, I attended this thing and you were presenting and now I have questions. You said you had a calendar. Great. Ask me. We'll do that. Email me. I'll send you the link. Someone shared that link out on Twitter once. It was very interesting because I actually got a bunch of people that were like from all over the country that joined my mentoring calendar for a couple of weeks. And it was kind of fun. I mean, those are really open slots. It truly is like, hey, I'm working on this one part of my value prop. It's not connecting with investors. They seem really confused. Why do you think that might be? I'll give you an opinion.
Well, that is super helpful, and what a generous offer to founders. It's also, I'm sure, I know you have done this beforehand to some of our SAC investors who are looking at, oh, I'm really kind of interested in this, and how might I take this to the next step in terms of becoming either a fund manager or just
yes. Absolutely. Yoko and I also love to talk to people who are new to angel investing. And I would especially direct them to Yoko because she has done so much more individual angel investing. She was at this full time for a couple of years before we launched First Row. And so she has, I think, about 40 companies in her individual portfolio. And so she's done a lot more of that. And she was also a fund manager for SAC. And so she and I are both always encouraging more people to join the ecosystem, and especially if they're doing it through something like, these APIS or SAC, where there is really the focus on sharing that due diligence experience and leveraging each other's skill sets. I think we're really, I think we took so much of what we enjoyed about SAC and brought it adapted it into First Row. So we always like to send people back to SAC.
Well, and it's very helpful. So people who are interested in the next SAC, I'll just put a little plug in. It's actually starts on August the 27th, right, Alex?
Mm-hmm. Sounds about right for that time of year. Yeah.
And if you're a company, you'll want to apply by August the 23rd through our guest profile.
And I think, I actually, my very first contact point with SAC was not as an investor, but as a founder. When the company that I was a co-founder of applied for Seattle Angel Conference, one of the investors was an advisor. And he said, oh, you would apply to the Seattle Angel Conference thing. And we were like, what? And I think we had like 3 days to put together our investment pitch. And, we didn't make it past, I don't think we got very far, but we did get to talk to an investor who gave us feedback on why we didn't proceed. It was so helpful. I think it's those kinds of experiences that make me really excited to do those Friday times, because I feel like now I get to be that person for somebody else. And I think that's one of the fun things about entrepreneurship is like you learn something, you get to share it with somebody else. And it's like, because as much as there is stuff written about this, it still feels like most of it's unwritten.
Well, learning from people who are in the trenches, I'm quite confident that 30% of it is reading books on it, but the next 70% of it has got to be connections and talking to other people and actual experience. So when you said that Yoko has 40 single investments, we always say that in your personal portfolio, you're aiming for 20 of them. And Elaine, you can say you are at that yet? Or?
Oh, I'm over 30.
Over 30. Okay.
Fantastic.
Yeah.
I mean, literally it's a statistics thing, which I can see why Elaine would gravitate toward this. When you really think of it as a portfolio, then you realize that the number of investments that you have matters a lot. And it's not about how great you are at being a picker. It's that you spread that out, because statistically that starts to then behave like a portfolio instead of one by one bets. And you have to get to a certain point for that portfolio effect to even take hold. So
and Minda, at First Row Partners, you guys are doing the portfolio too, right? I mean, absolutely. In terms of what you do.
Yes, yes. So we have, our strategy for when you model out, like, okay, we're going to have a $3 million fund. Well, how many checks are we going to write? What size is that going to be? Are we pursuing a strategy of acquiring an ownership percentage of a company, or are we just trying to do a return on like a multiple on that capital that we invest? Mm-hmm. And so there are all these different portfolio strategies you apply as a fund, which you could also apply as an angel if you think up front about what your total allocation is to the asset class, which is another thing I encourage people to think of. It's like your fund size is your strategy as a fund manager, but also as an angel, your allocation is also your strategy. And that's how you get to a healthy place in this asset class where you can hopefully get the most out of it.
I'm going to let Dart, I have a comment on that, because in terms of having that portfolio allocation, I would have said I'm really interested in health, but I actually have a strawberry robotics company with Elaine that we are so excited about. And I think good. Anyways, Darshan, do you want to jump in and ask your question?
Yeah, sure. I was in a situation recently where there was an angel investor writing a fairly large amount of check from angel point of view, but obviously small from VC point of view. But the deal fell off because the due diligence reached a stage where there was a whole lot of technology developed, and the investor wanted to get that technology sort of reviewed and thorough due diligence on the tech stack. It was a tech heavy product, obviously. And no one was willing to bear the cost. The cost for that itself was running in the tune of about $25,000 initial estimate. And there was no money with the team, and therefore they were raising capital, no money for such activity for sure. And the investor was saying, that's almost 25% of what I'm willing to invest. So have you come across such a situation? That deal obviously did not go through, but it was a great lesson for me as a consultant trying to put this together.
Yeah, I mean, in my perspective and my experience, and again, I have, my perspective and my experience, and then there's the whole rest of the world, because everything happens somewhere, is that doesn't happen in my experience. And so in my bubble, if someone wants to do technical due diligence, they take, as an investor, they take that on themselves. Usually they have somebody that are on their team or in their network that does that, and that if there's any sort of cost, it would be borne by the investor. I just would never see putting that on a startup. And it sounds, frankly, just a little excessive, because I think that if they don't trust that the technology is good, then, it's like, where does their trust really, how much, it's an indicator of future behavior as well. Like, are they going to want to have you get like a Deloitte and Touche audit of your books when you're 2 years in? Like, how much of this is an indicator of their future behavior, maybe being outside the market norms, and that they aren't understanding the risk profile of what it means to invest at this stage in this asset class, which is just, you never get enough information. You never get sufficient information. You have to make decisions with imperfect information and data. and that's part of it. And I would think that if I were to do technical due diligence on something, I go to the people that I know and I bring them in and I ask them what questions they would ask, and I will do that. But mostly I do reference checks on the technologists. And then that really tells me if they're up to the task. So I've gone about it sort of those two ways, but I've never thought to make a founder pay for it or do something quite that extensive.
Mm-hmm.
Yeah, I would add to that also. I think there are a lot of different ways to get at the same due diligence question sometimes. You know, you can have a technical advisor look at something. You can kind of look to see output. You can talk to a customer. All of that can be different forms of, you know, technical validation. And I think a good investor will try to find a way that it's not overly burdensome.
Right. Now, if they're doing M&A type due diligence and they're acquiring it as an asset, maybe that's more where they're familiar. But if they're an investor in a startup, I think Alex is putting it in a really nice way, which is there are a lot of different ways to get at the same information. Talking to customers, does it work? Are you using the API? Is it performing as expected? Hey, well then, you know, it may be imperfect, you know, maybe there's something that is, you know, is the technical architecture good? Well, did they bring in a good technical architect? Where has that person worked before? Have I done my diligence on them? And then you have to just trust, right? And then you have to know that a bunch of stuff's not perfect and you'll never know everything. You just want to avoid, obviously, like things you should not get surprised by, but yeah, it's usually another way to go about it.
Yeah, this is helpful. Thank you. Yeah, the ambiguity element will be there. So yeah.
And this is where, you know, talking to someone else can be really helpful and another founder. And I usually don't recommend people lean on their attorney too much because attorneys are designed to be in your corner to help avoid risk. And so to some degree, that sort of puts them at odds sometimes with the deal closing. So, you know, and you don't want to rack up a bunch of hours. You know, a lot of times when you're really looking for, is this a market norm? If that's the question, often that's a better question for an experienced founder or someone in the ecosystem rather than your attorney. Your attorney can tell you, no, your fund formation, your corporate formation documents and your board minutes are in order. And this is done correctly. That separation document is done correctly. This convertible note is saying what you think it says. You know, those are legal questions. Stick to the legal questions. But they've seen a lot of things. They do know some market norms. But I would suggest you lean more heavily on the people that are in the ecosystem as founders or active investors during this process.
Thank you.
Alex, you have your hand up. Would you like to jump in?
Oh,
Thanks,
yeah,
Dennis.
I've got a comment and a question. In Seattle Angel Conference, one thing's unusual about due diligence is that we kind of see the process all the way through. And you know, both the company as well as the investors do, and they're part of the educational process. In my personal investing, and I'm sure in yours, when do you decide that you've done enough? Is it when you uncover the first red flag? If when you have hit satisfaction with the red flags you identified at the beginning? How do you decide it's enough?
Well, we have a frame at First Row, we have a framework, and this is something Yoko and I kind of worked out. We have a champion model, which means that we don't have to both come to conviction, but that one person says, this is I'm going to take the lead and I am going to say I have come to conviction or I have not. And along the way, the first thing we do is we outline what our path to conviction is. We say, these are the things that I think I really need to be a firm yes and excited on for us to make this investment. This is post-screening though, right? I really lay out what I think the big areas are that I need to go after. And then I kind of might add to those, but I kind of get buy-off from my partner at the beginning that kind of like, hey, here's my path. I actually even share that with the founder and let them sort of fill in blanks with me. But then I go and I chase those things down, and along the way I get, you know, closer or further away to conviction. But at least then I know where I'm trying to get to, because you're never going to just, well, sometimes you do just get a feel, but I don't feel like that's a good use of time. And so I try and really anticipate where I'm headed. You know, I just do some upfront thinking about it, and I'll, you know, surf things around in my network and be like, do you really think that, you know, people are going to move to on-prem data centers Or is that not as much of a trend as this person says it is? You know, I'll ask around. And, you know, so that gets me closer and further away. But at least I know the kinds of questions I'm trying to get at. And sometimes new things will come up that I should chase down. But I try and lay it out at the beginning.
As we're drawing to a close, I'm just going to say a couple of things. One, Minda, thank you so much for your enthusiasm, energy, and what a great talk. And we're going to be sure that we share this. A couple of people saying this is a must listen to,
Aww.
especially as we're going into our due diligence with our next investors, right? About how much are you really asking of the founders? And so that's going to be great. The second thing is that I want to let you know, for startup founders who are here, we're having a session on Thursday. Minda gave some tips. Be focused as a startup founder to show some things. And so a couple of consultants are going to give us some that have been working with Seattle Angel Conference all along, and the founders, on how to stay focused on the things that are necessary, and more importantly, some tools to actually structure your focus. And so that's on Thursday at 12 o'clock, and stay focused on the meetup. So if everyone would do me a favor, and whoever's left here that doesn't mind doing it, is open up your camera, because I just want to take a picture of you as a group here for that. So if you could be with me, open up your camera for just a sec while I take a picture. If you can't do that, we'll understand. But I'll just do a quick one here. A big smile, everybody. Thanks, Chris, for jumping on. Here we go. Ready? Thank you. Okay.
So I'm always so glad to see so many new faces. I look forward to connecting with, you know, as many of you that are interested in connecting with me. You know, I always feel like there's a ton I learned from other people. I got a chance to talk a lot tonight, but I know that there's a lot of stuff out here that you guys already know and could share. So appreciate everyone being here.